Today, we're going to break down a classic business cautionary tale. We're talking about a merger that looked absolutely perfect on paper, a match made in corporate heaven. But in reality, it became a textbook example of what not to do. Let's dig into the failed marriage of Gillette and Duracell.
So to really get why this deal seemed like such a brilliant idea, you have to go back to the mid-1990s. On one side, you've got Gillette. They were the undisputed king of razors, an absolute titan in personal grooming across the entire globe. And on the other side, Duracell, the powerhouse of portable power. Their cash flows were just as steady and reliable as their batteries. You really had two undisputed champions in their own corners of the ring. So the thinking behind it all seemed incredibly simple, almost obvious. You take two market-leading consumer brands, you plug them into their already powerful global distribution networks, and then you just sit back and watch them grow way faster together than they ever could apart. On paper, it was the absolute poster child for strategic synergy.
And hey, this wasn't just some fantasy cooked up inside a boardroom. The market, the analysts, they were all completely sold on the idea. You had people like investment analyst Connie Minerity saying things like this was a brilliant deal, a once-in-a-lifetime opportunity. The consensus was crystal clear. This was a guaranteed home run.
And Gillette absolutely put its money where its mouth was. In 1996, they pulled the trigger, acquiring Duracell in a stock deal that was valued at a massive $7.3 billion. Let's just let that number sink in. This was not a small bet. This was a gigantic, company-defining move.
Okay, so you've got two amazing companies. You've got a clear vision. Wall Street is cheering you on. All the ingredients for success were right there. So the billion-dollar question is, where did it all go so spectacularly wrong? Well, the honeymoon period for this corporate marriage was incredibly short. The signs of troubles started showing up pretty fast. Just a few years later, by 2001, Gillette's stock had completely cratered, falling 45% from its high. And that Duracell division, the one that was supposed to be a new engine for growth, it was now being called an energy drain on the whole company. Ouch. All right, let's do a little postmortem here. Let's put on our investigator hats and break down exactly how this perfect deal managed to completely fall apart. And when you really start digging, the failure boils down to three fundamental and, with the benefit of hindsight, totally fatal flaws. The first, and you could argue the biggest flaw, was something we call the synergy illusion. Now, this is a super seductive trap. It's the belief that just because you have two really successful companies, smashing them together will automatically, magically, create even more value. But the reality, well, it turned out to be a whole lot messier.
Just think about it for a second. Razors and batteries live in completely different universes. Their manufacturing processes are different, their R&D cycles are worlds apart, and they need totally separate marketing playbooks. You plan a trip to the store to buy razor blades, right? But you grab batteries on impulse right at the checkout counter. Those incredible synergies everyone was talking about, yeah, they were a total mirage.
Okay, problem number two, and this was a big one, a complete lack of strategic focus. Look, Gillette's management team were absolute experts in the shaving business. They knew it inside and out. Suddenly, they were forced to learn and manage a completely unrelated industry, portable power, and that became a massive, massive distraction.
And that distraction had a very, very expensive name, the battery wars. Gillette thought it was buying this stable, predictable cash cow, but instead, what it really bought was a front-row ticket to a brutal, high-stakes war with competitors like Energizer, a war it was completely unprepared to fight.
And you can see just how intense this got. The moment Gillette tries to innovate with the Duracell Ultra in May of '98, bam! Energizer fires right back that very same month. This kicked off a relentless, tit-for-tat cycle of super expensive product launches and huge advertising battles. It trapped Gillette in a war of attrition that it just could not win.
So you have all this money, all this management attention and focus, just being poured into fighting the battery wars. What was the actual impact on the business? What did it get them?
Oh, the numbers tell such a brutal story. Just look at this. In 1997, Duracell's revenue was growing at a pretty healthy 10%. Now, fast forward to the year 2000, and it's shrinking by over 5%. But the real damage, the real story, is in the profitability. That operating margin, which is a key measure of how much money you're actually making, it just plummeted from over 23% down to 17%.
This war wasn't just costly, it was literally destroying the business from the inside out. And that brings us to our third and final reason. At the end of the day, this deal was a classic case of financial engineering winning out over sound business strategy. The whole idea was that diversification itself was the goal, instead of finding a partner that actually created a real, tangible competitive advantage. The deal looked great on a spreadsheet, but it made no sense in the real world. So, with the business performance suffering and all these strategic flaws laid bare for everyone to see, it became painfully clear that this situation just wasn't sustainable. Something had to give. The final verdict was in. The merger. The one that was once called brilliant was now understood for what it was, a fundamentally flawed concept. All it did was add immense complexity and distraction to Gillette's business without delivering a single one of the promised benefits or competitive advantages. And so, in a move that basically screamed, "We messed up," Gillette eventually spun off and divested Duracell. The company had to unwind the entire deal, pretty much admitting to the whole world that the grand vision they had back in 1996 had been a very, very costly mistake. Okay, after all that drama, what's the takeaway? What can we learn from this massive corporate failure? Well, there are a few key strategic lessons here that are just as relevant today as they were back then. First off, synergy has to be real and measurable. You can't just assume it exists because two companies have famous brand names. Second, focus is power. Venturing too far away from what you do best can be an incredibly dangerous and expensive distraction. And finally, and this might be the most important lesson of all, two great, healthy businesses can actually be much stronger apart. Just combining them doesn't automatically create a single better company. This whole case is such a powerful reminder that on a spreadsheet, 1 plus 1 can look like it equals 3. But in the real world, it can just as easily equal 0. And it leaves us with a really critical question for any leader out there. How do you separate that seductive illusion of synergy from the hard and often uncomfortable reality of a good strategic fit?